Well, in answering that, I have to repeat what we've said many times before, that the long-term investment performance is always due to the fundamentals of the companies that we invest in. So if the company is able to increase its economic footprint over time, the valuation of the business, all other things being equal, should improve over time. But clearly the fundamentals of the businesses that we were involved in, the economic fundamental of the business, not the market price associated with it, didn't increase by anywhere close to 29%. And in fact, if you have a look at the market as a whole, depends on whose data you look at, but probably the earnings growth over the 12 months was around 3-4% for the index as a whole. Well, our companies were substantially better than that. So that's the key thing that drives the investment performance over time. But when you have a look over the past 12 months, what actually also added to that massive improvement was we had a tailwind that was driving everything up. That was the improvement in market sentiment. So when you get an improvement in what we would call the PE multiple, which is the valuation that the market ascribes to the companies, when that increases and you have earnings growth as well, you get a double whammy. So you might get, say, 10% due to the earnings, and then you might get another 20% due to the improvement in the valuation. In our case, if you look at the 29%, 4 of that was dividend yield on the stocks, roughly 3.5-4%. Then we had earnings growth, which was anywhere close to 16% in some companies, higher than that. And then you have the B expansion on top of it. So it's clearly that total return is due to 3 things. One is the dividends that we get from the companies. 2, the fact that they all improve their earnings better than the market. And 3, also the valuation of those stocks improved at a higher rate than the rest of the market. Now, the improvement in the valuations, that's some years it improves, some years it goes backwards. I mean, that's a factor of the market. It's kind of like the tide. And we've got no control over that, and it's due to interest rates and various other things. But what we can do is pick companies that can grow the earnings like our companies did over the past 12 months. I'm on record a number of times of saying that we're armchair experts. We know these companies to the extent that externals can get to know them as well as anybody else. But there's a lot about the businesses we don't know. And to that extent, we're relying on the management of the businesses to negotiate that business when there are headwinds. So they're across every facet of the business. And if they weren't, we probably wouldn't own them. But those managers see consumers maybe getting a bit wary of buying their product, or see what the impact of interest rates will be, or inflation will be on the products that they buy, or the resources that they have to purchase. And they will take steps to alleviate whatever they see. So if they see the cost inflation being higher than what it is, they'll source it from somewhere else, or they'll get a replacement product. They are there to manage the business into these headwinds that they're seeing. And for us, that's how we deal with it, is that we pick quality managers that are managing the business and getting us the outcomes that we want in different market conditions or economic conditions. The factors that you highlighted are what people would call macroeconomic factors, relating to interest rates, which is a macro factor, inflation, that's dependent on supply and demand of the overall economy and the global economy. And when we manage portfolios, we do not start with macroeconomic factors. Clearly, they impact on the underlying businesses, and as I said earlier, we rely on management to navigate through whatever changes they're seeing in the macroeconomic environment for their business. But we don't take positions of selling it an entity because the carbon price is going. We're not a macro manager. We don't manage according to macroeconomic factors. We look at the microeconomic factors relating to the business. Now, clearly, some of those translate in our modeling. So if the interest rates are going up and the company's got a whole lot of cash, so we would increase the earnings from that cash component of the balance sheet. So we do have, views on where some of those are going, because when you model business, you have to, obviously model the key drivers of that business, and they might be driven by an increase in wood, for example, if you're into using wood in your construction company. So we do take them into account, but we don't position the portfolio according to macro factors. Oh look, there's always a lot of things that interest us. I mean, the big theme at the moment is AI and how that impacts, and we don't structure the portfolio according to themes at all. It starts with the quality of the underlying business, and yes, AI is going to have an impact on some businesses, enable them to deal with their customers in a better way and interpret data in a better way. So yeah, we would see how that would impact on. But thematics is not something that we hang our hat on. But for the investors in flagships, our current, what we call internal rate of return, is about 16.5% for the portfolio. That's on a dividend yield of about 2.5%. And historically, it's played out roughly the way that we always forecasted. So we're always kind of in line. We expect the multiples of the stocks that we're in, they've had a really good run up to this point, to maybe contract a little bit by about 2%. So that offsets the dividend yield that I'm talking about. And then about 16% growth in earnings. So our internal rate of return is north of 16%, which means over the next 5 years, our investors should look to get at least a 16.5% return from the portfolio that we manage.